So there has been a lot of talk about past financial bubbles in class, such as the tulip bubble that took place in the Netherlands 300 years ago, and the housing bubble of 2007 to 2008. Well, today I will be talking about a bubble that is growing even as I speak. If you have been following the news recently, you might have heard of this new virtual currency that is all the rage right now. That's right, that currency is Bitcoin. For the past year or so, people from around the world have been flocking both in and out of this investment, and its price has ranged from $5 back in 2012 to around $1,200 during November last year. Before I go further into Bitcoin, let me first explain what Bitcoin is and how it works. Basically, Bitcoin is a virtual currency created back in 2009 by a person or a group of people under the alias Satoshi Nakamoto. The idea for Bitcoin was to take power out of the hands of the government and bankers, who usually control the flow of currency. Because Bitcoin is not controlled by any group of people but rather managed by an extremely complicated computer program, it cannot be manipulated, which makes it so popular. Also, as money is transferred directly between two parties rather than through a bank or a credit card company, the fees for using it are minimal. Going back to what I said before about the price of Bitcoin, the current price of Bitcoin is $500. Even though it is down from the peak of $1,200 last year, it is still 10 times more than what it was 2 years ago. Surely such an alarming increase would be ringing bells, and that is exactly what is happening to analysts around the world today. In fact, many of them are calling it the Bitcoin bubble that may burst at any time. Let's take a look at the classic bubble illustration, which was composed by Jean-Paul Rodrigue of Hofstra University. Now let's compare it with the price of Bitcoin over the last 2 years. Isn't there a striking resemblance? In fact, Bitcoin has been through several small bubbles, such as in 2011 when it went from $1 to $17 then back down to $3, and in early 2013 when it raised to $140 from $20 then back down to $80. Despite this astounding volatility that the Bitcoin has demonstrated, many people are still buying Bitcoins just because all their friends are buying it and making a lot of money. And they hope that the value of it will rise because others are willing to pay more for it than what they did. However, smart economists know that this is a stupid thing to do, especially since how Bitcoin is just an imaginary currency. Some are even comparing it to the tulip bulb bubble of 1637, where few had even heard of the tulip when its prices started to rise drastically. So the question is, will the Bitcoin maintain this volatility, or will its bubble eventually burst, reducing it to be worth mere pennies? No one knows for certain, but one thing is for sure. If the Bitcoin bubble does pop, smart investors will not be caught in the middle of it. Of course, the best strategy would be to avoid the Bitcoin completely, but if one really must invest in this virtual currency, then they should only dedicate a small portion of their assets into this investment. By spreading the rest of their assets into safe, low-cost stock and bond index funds, such as the Vanguard S&P 500 Index Fund, and continuous rebalancing of their portfolio to maintain the ratio, investors will be able to sell when prices are high and buy when prices are low, saving themselves from financial devastation.